My name is Rod June, and I am the Chief Investment Officer at LACERS. Welcome to the 2024 LACERS Emerging Manager Symposium. On behalf of the LACERS Board of Administration and staff, I am honored and excited to address all of our interested stakeholders in LACERS Emerging Manager Program, particularly the community of emerging managers who are already managing assets for LACERS, and for those firms which aspire to manage assets in the future on behalf of the approximately 60,000 members of the system. New for this year, LACERS has chosen to offer the symposium in a virtual format in order to have greater reach to its various stakeholder audiences, but to also allow for more frequent updates to the video as may be necessary to keep pace to the fast evolutionary disruptions within the investment industry and any changes to LACER's investment program and policies. LACER's Emerging Manager Program has undergone evolutionary changes over the last 30 years, but has progressed to a more formalized and structured program with greater policy guidance. At that time, in 2000, more focus was placed on emerging managers in private equity and private real estate, but as well encouraging up and coming public market managers to participate in LACER's open and competitive request for proposal hiring process. What has not changed is LACER's focus on superior investment manager performance, which drives how and who gets hired to support LACER's organizational mission. You will find that LACER's website at lacers.org supports the EM Resource Library, where there you will find access to past symposiums, performance reports, RFP contracting requirements for public market manager searches, and investment policy. I strongly encourage you to review the EM investment policy, which provides a general understanding of minimum requirements needed to be considered for managing LACER's capital. And as stated in the EM policy, LACER strives to allocate no less than 10% of its capital to EMs who meet its policy and program criteria. Keep in mind that meeting minimum criteria does not guarantee an allocation, as that will be determined by policy, program guidelines, staff, its consultants, due diligence, and in some cases, by advanced approval of the board. The different processes can be bewildering. So in addition to the resources I have outlined, my staff and I are available to assist you. If you have further questions, reach out to us at lacers.invest@lacers.org. Today's symposium will begin with a brief state of LACER's Emerging Manager Program that includes a discussion of my assessment of the progress for calendar year 2022, followed by two insightful fireside chats conducted by Wilkin Lee, my deputy CIO, and Ellen Chan, my director of private markets, and then followed by closing remarks from LACER's general manager, Neil Guglielmo. So let's get started by reviewing the recent highlights, which more program details can be found in the 2022 Emerging Manager Annual Report found in the Resource Library. While LACERS has achieved the 10% exposure goal within its private equity asset class, other broad asset classes, including public equities, fixed income, real assets, and private real estate, while generally seeing increases in the dollars that have been allocated to EMs, have not met that 10% allocation and exposure target. There are reasons. COVID, as well as rising interest rates and inflation, have caused public pension plans like LACERS and investment management firms to re-examine their strategic direction in a more concerning geopolitical, social, economic, technological, and public health environment, while also addressing internal operational, organizational, and staffing issues. Juggling such concerns has been a major distraction of our EM efforts. Now that many of these past concerns and issues seem to be better understood and managed, I believe all of us in the EM community can redirect our attention to the important work with and around EMs. Performance is the primary driver as to why we pursue emerging managers to manage LACERS capital. So let me account for that as follows. The three real estate managers are performing reasonably well despite the challenges seen in the real estate industry. The 29 private equity managers are mostly out of the J curve, and most pre-2019 vintage funds have satisfactory positive net IRRs. And finally, two EM public equity managers who have at least a 5-year track record with LACERS are beating their performance benchmarks. In order to scour a wider universe of investment managers, staff have attended close to a dozen emerging manager conferences and events over the last several years. It is noteworthy that LACERS staff took over 180 EM meetings in 2022, which is a strong testimony of our staff's efforts to relationship building. LACERS' 3 investment consultants, NEPC, who advises us on the general portfolio and public markets, Axia, who advises us in private equity and private credit portfolios, and Townsend, who advises us on our private real estate portfolio, assist LACERS with our emerging manager programs and take meetings with EMs. In order to help achieve our policy objectives, staff prides itself on its level of outreach through its Emerging Manager Symposium, the networking forum, in-office and virtual meetings, and making introductions to its investment consultants. I appreciate hearing from you so that we can improve our support of the important investment work that you do. My staff and I will do what we can to help you better understand the investment manager selection process. We want you to be well informed about how to do business with LACERS so that you are poised to one day manage our capital. Let's work together to bridge that gap. Finally, I want to thank you for joining us at the 2024 LACERS Symposium. I hope you learned something new, find our EM program and resource library helpful, plan to participate in the fall 2024 networking forum, and continue to stay engaged with LACERS as our EM program grows and continues to move in a positive direction. This concludes my remarks. I want to thank the Board of Administration for the support that they have given to staff and myself in supporting the Emerging Manager Program efforts. Please stand by for the informative fireside chats. I think you're going to like them. See you soon, and thank you for building a relationship with LACERS. Goodbye.
Hi, everyone. Welcome to LACERS Emerging Manager Symposium. My name is Ellen Chen, and I am the Director of Private Markets and the ESG Risk Officer for LACERS. In continuing with our theme of graduation, we're very excited to have one of our graduated public markets investment manager, Oberweis Asset Management Inc., here with us today. And I have the pleasure of having Brian Lee, who is the Principal and Director of Sales and Client Services with us. Prior to my current role in private markets, I managed LACERS non-US equity portfolio and worked with Brian directly for a number of years. Brian, how are you doing today?
I'm doing fabulous, Ellen. Thank you for the opportunity. It's great to see you.
Perfect. Glad to have you here with us. So just by way of background, Oberweis first became a manager for LACERS back in 2014 through our RFP process. And Oberweis won the mandate in our developed market small cap strategy. And LACERS initially funded this mandate with $33 million. And now you manage $340 million for LACERS. That's quite a growth.
You know, I'm super fortunate to have the opportunity to work with such a wonderful and very professional bunch at LACERS. They've been a great long-term partner for Oberweis Asset Management and gave us an opportunity in what was a fairly, new asset class, believe it or not, in 2014 in the international small cap space. So super appreciative to be given that opportunity to vie for that business and lucky to have the opportunity to work with such wonderful people over the past decade.
Oh, we're happy to work with you. So by definition, for everyone out there, you've outgrown our emerging manager criteria, which is a firm with no more than $2 billion in total firm AUM at the time of hire and a minimum of 50 million AUM in the strategy being considered. So what we plan to do today is to go over the history of your firm, discuss how it's evolved, and hopefully for the people online, this interview can serve as a case study to learn how to become an emerging manager with LACERS. So Brian, again, thank you for joining us on our symposium. And let me start off by asking you to describe Oberweis when you first started investing for LACERS, and what does Oberweis look like today?
Yeah, so the business has changed, I would say a fair amount, over the past 10 years, certainly. I've been with the firm going on 22 years. It'll be 22 years this April 10th. So the firm has certainly grown, has gone through growing pains. I think that's typical for a firm that's certainly looking to continue its excellence, to improve upon the infrastructure that the firm has, to invest back into the business. So the business at Oberweis is definitely a different business than it was, even going back to when we started working with LACERS in Q1 of 2014, specifically January 15 of 2014. And we first started talking to LACERS about our international small cap strategy going back to the early part and mid part of 2012. I had the pleasure of interacting with CIO Rod June and now departed Brian Fujita, and we had some really great and fruitful conversations about the international small cap space as an asset class, how we view the asset class fitting into an overall asset allocation, the diversification and alpha benefits of the international small cap asset class. And believe it or not, in 2012, international small cap really wasn't an asset class that was used as a standalone allocation by very many pension plans. In fact, the ACWI IMI index, which became more of the all cap index, didn't really become available until May of 2008. So it took a couple of years, I think, for the institutional consulting and plan sponsor world to recognize, hey, maybe we're not as overweight in the small cap space internationally as we thought. And luckily for us, there started to be some momentum in the asset class, and institutional investors begin to recognize, hey, wait a second, there's something here. Maybe we should take a look at it. And it just happened that the conversations that we were having as a firm with LACERS was around the asset class, why the asset class was value added, interesting. And knock on wood, in mid 2012, we eclipsed the 5-year track record. That track record was a compelling track record relative to bench and peers. And it seemed like there was some potential interest by LACERS to look at that international small cap asset class as an allocation.
Perfect. No, that's amazing. So was there anything memorable about your process of becoming a LACERS emerging manager?
Yeah, so we were super fortunate to win the confidence of the internal staff at LACERS and their esteemed board. We were awarded a $33 million mandate on January 1 of 2014, as I mentioned. And quite frankly, I mean, LACERS win was a very big win for us. When we first started talking to LACERS in earnest in mid 2013, as we started diving deeper into the philosophy process, and really as LACERS began to more seriously consider us as a potential a manager for their platform and for their emerging manager platform, we were only at about 100 million in total strategy AUM, and firm AUM was just a little over 600 million. So very, very much an emerging manager. And thanks to LACERS allocation and the notoriety that came with working with a very well-regarded, multi-teen billion-dollar oriented pension plan, it really added kudos to our effort and helped us J-curve institutionally. So, from the time that LACERS first hired us, we were about 240 million in international small cap assets when they initially funded. 1 year later, we had over $1.5 billion in international small cap assets, and it eclipsed the $2 billion firm AUM level, which is kind of the upper boundary of LACERS emerging manager definition. So thanks to the allocation of LACERS, it incrementally added capital, which then helped us J-curve in convincing more institutional investors to give us an opportunity. Excuse me.
Yeah, no, we enjoyed working with you. I know, Brian, you have a story to share in terms of presenting to the board. Would you like to share it with everybody?
Yeah. So, again, we've had the pleasure of working with LACERS, and I've had the pleasure of working with Ellen for a number of years now, and I'm sad that I don't get to work with her on a day-to-day basis. any longer, quite frankly, but great teams stepping in her shoes. So we have to go out on a somewhat regular basis to present to the board. And in particular, this is before COVID. We were asked to come out and present to the board, which of course, happy to do so. We had already graduated. Assets in the strategy were in the $200 million range. So certainly a very, very meaningful client by all measures. So while we're waiting to go up in front of the board, we had asked to have a little bit of a workspace. So we were put in one of these consulting or counseling offices that sit adjacent to the old boardroom in LACERS' old location before they moved around COVID. And we're sitting in that room working. And while I'm underneath the desk plugging in our laptops to work, I noticed there was a button under the desk. And being the maybe not super mature and curious individual that I am, I decided to push that button. Lo and behold, that button was a panic button that could be used by an individual counselor who's talking to a potential retiree. And if something's going bad in that meeting, they could push that button and receive help. The IT team from LACERS came rushing into the room and asked if everything was okay, which of course it was. I didn't know why they were concerned about our well-being, but they certainly were. And then after a few minutes of the excitement of that coming down, I think on the LACERS team's behalf, it became pretty clear that that was a panic button that was communicated directly to LAPD and that LAPD would be en route. I also did not know that there are video cameras in these counseling rooms for obvious reasons, correlating probably to a need for a panic button. So, of course, all of that was recorded. And I'm sure somewhere in LACER's office, somewhere has a picture of me under the desk pointing to that button, getting ready to push it.
No, I mean, obviously, we've had a long history with Oberweis and with Brian, with you in particular. So I think it just highlights, we have fun as well, right? Maybe not quite the kind of fun we're looking for, but it's been exciting.
Well, we like to be, remembered for our performance and the quality of our investment work and fundamental bottom-up research. But I suppose, maybe in this case, even negative press is good press. I guess.
Brian, what are some of the challenges Oberweis faced as an emerging manager? And I know, obviously, we ramped up that J curve really quickly, but maybe if you can share some of the challenges you faced.
Yeah, I think, being an emerging manager is I think, pretty hard. There's various definitions of what emerging managers are, but let's just stick to the asset level one. As is typical in the institutional world, there's big dollars allocated. There's quite a bit of risk that's being taken by the allocator to allocate that capital to a given manager. That manager then has to, of course, undergo a significant amount, not only of investment due diligence, but in many cases, operations and compliance due diligence. And oftentimes, being able to inflect in assets begets future asset growth. So it's kind of the chicken or egg. And I think it's a challenging one because there's a lot of very talented investors out there vying for allocations. And it's just even more important that the investment professionals are incredibly talented at what they do, but also have the ability to very easily, clearly, and directly communicate what they do. The challenges are many. I mean, I think scale is certainly one. Scale as far as AUM, because asset growth generally can beget asset growth. Scale as far as professionals, not only sales professionals, but also client service professionals, operational professionals, compliance professionals. So as an emerging manager, there are a number of hurdles. Scale, I think, is at the top of the list. I also think, unfortunately for emerging managers, there's a misperception maybe surrounding risk. You can have very incredibly talented investment professionals with great back office, great compliance, but because their assets are low, there seems to be a higher level of risks that are allocated to those shops. Even if those shops are profitable, are managing their expenses in a very smart manner, there's also a risk perception that I think is difficult to overcome. And I think all of that then correlates back to brand image. In this world, certainly over the past couple of years, and increasingly, I think on a go-forward basis, digital marketing and outreach, I think, is mission critical to building a brand and maintaining a brand. And I think, when you're a boutique shop, when you're an emerging manager, it can be a little difficult to achieve that scale, quite frankly, as well.
Got it. Any good advice you'd give to any new emerging managers out there?
I think it's going to be really, really important that if you haven't already launched your firm, or you're thinking about launching a firm, I think it's going to be mission critical to understand where your strategy fits in the overall allocation for plan sponsors, for whoever your target audience is, OCIO, whether it's wealth, high net worth, family office. So I think it's super, super critical that you understand where your strategy fits. That will help you position your strategy when you talk to potential investors. It'll also help you frame up what the opportunity is, what the risks are. And then it also, I think, dovetails with, what differentiates you from your peers. I do think it's really important, especially for emerging managers who don't have sales staff, where the investment professionals are out there on the road telling their stories as they begin to scale up. Please create a script for yourself, rewrite the script, make sure you understand what the key components are of that script, what are the differentiating factors that you bring to bear, and do it in a very clean, concerted, and straightforward manner. So build scripts, rehearse those scripts, edit those scripts. It will really help you stay on task and on point as you begin walking through your 4 Ps, your people, your philosophy, your process, and performance. So I definitely think that is very, very important. I also believe that as an emerging manager, certainly from my view, you probably want to start talking to the end investors directly before you start talking to the consultants. I know that may be a little different than what happens generally in the institutional business, but I would encourage you spend time with the plan sponsors. It's their capital that is being allocated. So I'd start with them. Oftentimes you can find that they tend to have a little bit more degrees of freedom than the consulting firms, who tend to be more constrained based off of their average client instead of a very specific one.
That's really good advice. So
one more thing, if possible, I'm sorry, this is a long answer.
no, please.
If your strategy is one that could be put into a commingled structure, I would encourage to do that. Yes, that will cost you more money to do, but it'll broaden who you can actually reach out to in regards to the strategy. Early on, you're looking to collect nickels and dimes, proverbial nickels and dimes. So if you have the ability to do that without putting strain on your operations and reconciliation and trading team through a commingled structure, I would do that. Definitely over trying to build separate account by separate account.
Perfect. So Brian, you've done all that. So how do you envision Oberweis going forward now that you've quote unquote graduated?
Well, we could always use more money from LACERS, but in all seriousness, we've definitely been adding to the infrastructure of the business. As it relates to my team, the sales and client service team, we've added 2 new professionals over the past 3 years, not on the institutional side, quite frankly, on the wealth side. It's not an area that we've spent a lot of time at Oberweis. We're a public equity long-only shop. So certainly public equity is a space that the ultra high net worth and wealth space allocates to. We already had the commingled vehicles and mutual funds and private funds. So what we didn't have is relationships, expertise, and bodies to go out and communicate what we do in that marketplace. And so we've made a big investment to bring 2 professionals on. They've done a fabulous job. At the time we brought them on 3 years ago, institutional assets versus retail assets were 80% institutional, 20% wealth. Today, it's 60% institutional and 40% wealth. So we've absolutely seen a significant amount of growth from the wealth space, which, quite frankly, is a nice diversifier to have as far as a business.
Perfect. So with that, I want to thank you so much for your time, Brian. I found this to be very informative. I'm sure everyone else out there will as well. And so hopefully you got a glimpse of our public markets success story. And I want to thank everyone for their time. So I'll pass it off to Wilkin Lee, who is LACER's Deputy CIO. Thank you so much for your time, Brian.
Thank you, Ellen. All the best.
Thank you.
Hello, everyone. Welcome to the LACERS Emerging Manager Symposium, and we're very excited to have you here today. My name is Wilkin Lee, and I'm the Deputy Chief Investment Officer for LACERS. And continuing with our theme of graduation, we're very excited to have one of our graduated private equity general partners here today, which is Oak HCFT. I have the pleasure of having Andrew Adams join us, who's one of the 3 co-founders of Oak HCFT. How are you doing today, Andrew?
I'm great. How are you?
Good. Glad to have you here today. Just by way of background, Oak HCFT was founded in 2014, and they spun out of Oak Investment Partners, which is a multi-stage venture capital firm. Oak HCFT focuses in the venture capital and growth equity space within the healthcare and fintech sectors. They currently have $5.3 billion of assets under management and 35 companies that have achieved valuations in excess of $1 billion. LACERS dipped our toe initially by committing $10 million with Oak HCFT as emerging manager with their Fund 1 back in 2014. They have now grown to the point where they are our 10th largest GP in terms of exposure, as LACERS has continued to stand by their side and committed $135 million through their Funds 1 through 5. By definition, they've now outgrown our emerging manager criteria and serve as one of our core private equity managers. By policy for our emerging managers, we look at institutional funds 1, 2, and 3 when fund size is no larger than $750 million for Fund 1, $1 billion for Fund 2, and $1.25 billion for Fund 3. On top of being a graduated emerging manager, Oak is actually one of LACER's highest returning GPs in terms of performance. They have an aggregated 26% net IRR and 1.8x TVPI across all of our fund investments with them. Back in June of 2023, Oak HCFT was named one of the 10 best performing venture capital firms in the world, according to a study by HEC Paris Dow Jones. So we want to congratulate them on that accolade. What we're planning to do today is go over the history as a firm and how they've evolved from emerging manager to an established manager. Hopefully for the folks on the line, this interview can serve as a case study on how an emerging manager can eventually grow to a core manager alongside their LPs. So Andrew, thank you again for joining us in our symposium. Let me start off by asking you about your background. Can you talk about your own personal story and how you grew up in Texas and how you eventually got to finance after attending Princeton? Curious to know how you landed at Alex Brown, one of the original 4 horsemen, and eventually at Oak Investment Partners.
Sure, absolutely. And Wilkin, thank you for having me. And we certainly appreciate your support and LACER's support over so many years. My background, I did grow up in Central Texas on a farm. And it was really, I think, formative for this conversation, in the sense that while it was a rural environment, I had access to a great hospital system at a young age, which doesn't sound that important, but when it influences your life, in an early age or throughout your childhood, your families, it has a great and tremendous positive impact. And I certainly saw the impact on the community just in terms of general health care and the jobs it created. So that, combined with the more personal impact of my mother being a nurse, really set a foundation for my interest and passion around healthcare. I was also very interested in the stock market at a young age. So it was just a natural extension of these influences and experiences and interests that led me into finance and ultimately investing. As you noted, after college, I did go to Alex Brown. And I loved Alex Brown in the sense that it was one of the small banks, as you know, one of the 4 horsemen. So working closely with leading technology entrepreneurs and growth stage companies. And I just love that energy. And I always wanted to get closer to the companies and to the entrepreneurs. And that led me to move over to the investment side and ultimately to join up with Annie Lamont at our predecessor firm to go deeper on both the healthcare side, but also working closely with entrepreneurs and leading growth companies. And, my partnership with Annie has been an incredible experience ever since.
No, that's great to hear. Yeah, that's very exciting story. I used to work at JP Morgan H&Q, so we heard a lot of good stories about Alex Brown as well. So given that you're already pretty successful at Oak Investment Partners, what was the thought process and impetus as to why you and Annie decided to spin out and form Oak HCFT in 2014? I'm sure that was a big leap of faith for you all.
Well, it was, but it was also just a natural progression. I think in what we had built at our predecessor firm. We had spent a decade plus investing in both healthcare and fintech with some of the leading companies in those two spaces. And looking at the market opportunity ahead of us at that time, we saw a $4 trillion market in just US healthcare alone, and multiples of that in fintech on a global basis. So there was decades of runway for our strategy. We had, a very successful run and worked with, again, great entrepreneurs and leading companies and had some tremendous outcomes at our predecessor fund. And we were confident in our strategy based on those instances. And so that led us to look at, okay, where else can we go? How can we expand what we're doing today? And the natural progression for us was launching our own firm and our own funds to pursue this strategy just on greater scale and build the team to support that effort. That's what we started in 2014.
Yeah, maybe you can talk about some of the challenges you all faced when initially trying to attract institutional capital from LPs. Were there any key milestones that you had to get over that initial hump?
Sure. Well, we were fortunate in the sense that we had two significant anchor LPs in our first fund. One LP is a group that we had known for some time. They were familiar with us. They were familiar with our strategy, with our track record. And that was paired with another LP that had gotten to know us and our track record through some secondary purchases in our predecessor fund. So it was really the combination of those two anchor LPs that gave us the foundation to launch Fund One. And after you had that in place, then things started to fall into place. Again, as you noted, we had relationships with a broad LP base from our predecessor fund. So we continued some of those relationships, and we also developed new ones with our first fund. But again, coming back to those anchor LPs, we'll always be grateful for that early support. Certainly, LACERS was there at the beginning, and once you have very strong institutions in place, then it just kind of builds as you're putting together your first fund.
Yeah, even from our perspective, seeing large anchor LPs helps us as a say a potential LP to look at the GP themselves and kind of underwrite them as well. So I think definitely putting initial capital in Fund One and growing is kind of key, assuming that the relationship goes well. So what are some common mistakes and misperceptions that emerging managers have when reaching out to LPs? I'm sure there are a lot of faux pas that you can talk about.
Sure. Well, what was important to us was being incredibly clear with LPs. And I put it into three categories. One was incredibly clear about who we are, like who is the team that will be driving the firm and the first fund. And we had the benefit of working together for a decade plus. So people could see the partnership that was already in place with Annie and me. So that was kind of point one. Point two was the strategy, being very clear about the strategy. It's in our name. We focus on healthcare and fintech. The types of companies we work with, the types of entrepreneurs, the types of underlying strategies has been very consistent since the early 2000s. So seeing how our strategy could be implemented in a dedicated fund was not a significant leap of faith for LPs. There was a lot of reference and history to spend time on. And then lastly was our results. We had a very clear track record that was, again, led by and executed by the founding partners of the firm. And we had a very well-defined strategy that drove those returns. So it was really the combination of the team, the strategy, and the results, and being incredibly clear and transparent with LPs about that I think set that up for success. So I would encourage emerging managers to really keep in mind and spend a lot of time refining that and defining that before starting to reach out to the initial slate of limited partners.
No, that's a great point, Andrew. I think from my perspective, when I do speak with emerging managers, oftentimes we focus on what they've done in the past. And when they are situations where they are strategy drifts, depending on the economy, those are things obviously we prefer them not to do. We want to make sure that they have an expertise, stay in that lane, and kind of develop that strategy over time. We also do quite a number of reference checks. Our consultants dive in very deep as well. So to the extent that everything is transparent, that the story makes sense, I think that's what's key to us. And obviously made it very easy to underwrite your funds given your history as well. We all know it's a small business here, and relationships do matter. So we definitely appreciate the transparency and the history that you all have provided to us. So maybe can you talk about how your relationships with LPs have evolved over time? Obviously, when you were at Oak Investment Partners, and then you had those anchor LPs, and now you obviously have a very large, large enough firm where you have $5 billion in assets under management. Maybe can you talk about how that relationship has evolved, the customization aspect, and how you work closely with your key LPs?
Absolutely. Well, it's almost as much changes, things stay the same. And you touched on it. The relationship that we have with our LPs is incredibly important to us, and it has been from day one. So even beyond those two anchors, organizations like LACERS and a lot of the other LPs in Fund One that are still with us today, those are incredibly valuable and important relationships to us. And so it's incumbent upon us to be very transparent with our LPs about our team, our strategy, our results, what we're focused on, where we see opportunities. And that's the trust that we want to continue into the future. And as our fund sizes have grown, certainly we've added a handful of new limited partner relationships with every fund. We will continue to do that in the future. But what's important to us is to make sure we have that direct one-on-one relationship with our LPs. And it never turns into something where there's, hundreds and hundreds of relationships where we don't feel like we have the personal touch, and where the LPs don't feel like they have kind of direct connectivity with, Annie and me, and also, the fantastic investment team that we've built today. So those fundamentals are going to remain, cornerstone elements of what Oak is as a firm and who we are as the principals at the firm.
And that's great to hear. So Andrew, as you know, it's been a very interesting fundraising environment that we're going through right now. A common pushback from LPs like LACERS is that we tell GPs we like their strategy, we like the organization, but we're having a challenge right now with the denominator effect and the number of new funds that we commit to. So how do you address that as a GP when you hear that? I know obviously capital is very scarce nowadays. You have the risk of investing with somebody new versus an existing GP who's a known commodity. So how would you address that during fundraising periods?
Well, I kind of take a step back and look at it, even from a GP perspective. So we are dedicated to healthcare and fintech. As I mentioned earlier, these are incredibly large and evolving markets where there's endless amounts of opportunity for our investment strategy. What I see in the market is, healthcare and fintech for a generalist firm can fall in and out of favor. I think for us, given the flexibility of our investment strategy, there's always going to be an opportunity for us, given our familiarity and depth in all of the many subsectors under the healthcare and fintech heading. So we are making a long-term commitment, and we have and will continue to these two categories. So our interest in healthcare or fintech is not going to ebb and flow based on kind of what's happening in the macroeconomic environment, like the denominator effect that you cite. I mean, my view on that is that's a temporary phenomenon. And in order to have long-term success and a long-term successful returns and results is a long-term commitment. And I think it would be hard to try and pull back or heavy up on venture or growth or private equity based on what is a short-term phenomenon with a public market cycle. So the long-term orientation that we have to our segments is really, what I think is the winning strategy for just long-term success in investing.
No, that's absolutely true. I think that's something that we keep in mind as well, as obviously a public pension plan system where we obviously have a lot of the public looking at our current allocations, but we obviously realize that private equity is a long-term game here. We have a 5-year investment period, 5-year harvest, numerous extensions, and we obviously know that right now the economy is going through an interesting time, but the flexibility that as a GP that you all have, you control the exit period, you control a lot of levers that could hopefully get a higher realization. So we don't want to look at taking a short-term perspective on this view of private equity. So, given that your firm is, relatively mature now, I'm curious to hear about what other initiatives Oak HCFT is working on to grow the firm. Are you looking at any credit strategies, any new sectors, anything else to grow the firm?
No, we have always pursued a fairly flexible strategy, but one where we have a specific allocation to early stage venture and then the vast majority to growth companies. And there's a range of the type of growth companies. But we like that to be all in one fund. We want every company, every investment contributing to the blended returns. And the way we put our portfolio companies and together in a fund has been very consistent over the years. And that works for us. It works for our strategy. It works for how we built our teams. And we think it works for how the market opportunities evolve in both healthcare and fintech. So we will continue with that focused strategy as we have to date as we think about our future funds.
No, that's great to hear. I think from my perspective, it's easy to underwrite you all. We know what you're investing in. So I think, really appreciate that you stick to your expertise here. I'm curious, just to kind of wrap things up here, do you have any advice or anything you'd like to say to the audience members on the line who may be similar to yourself back in 2014 when you started Oak, or maybe you can share kind of the best advice that you received when raising your funds?
Sure. Well, I'll give you advice and experience as I reflect back. The advice, which was not a hard sell with Annie and me, was just to, even at day one, really focus on hiring the best for the team. And we have done that. We have an incredible group in all aspects of our firm that have been with us a long time. And we feel like we've built something very special. We hold our team in incredibly high regard, work very hard, are incredible supports for our entrepreneurs, have great judgment on opportunities and people, and are really passionate about the end markets and what Oak HCFT is all about. I mean, you kind of cite that we're mature at our fifth fund. I mean, we still have a startup mentality. I mean, we are always pushing ourselves as a team to do better. And so it goes back to that kind of advice, but focus in the early days on just hiring an incredible team right out of the gates. And, I couldn't be happier. And it's just such a strong foundation as we think about adding and growing in the future. And as I reflect back on the experience, which is, I'm sure, going to be something familiar to all the emerging managers on the line, is, it is a lot of work in those early days because you're launching not only a fund, but you're launching a firm, and putting all of those pieces into place and getting set up for success beyond just the team, which is incredibly important, is a lot of work. And it was the hardest I've ever worked in my life. But as I reflect back and look at kind of what we've accomplished over the past decade and the outlook for our team and our strategy going forward, I just couldn't be more excited about it. And every hour, minute spent thinking about this, launching it, from 2014 today has been so worth it. And it's been just an incredible life experience, I think, for Annie and me and our entire team. And we're just very, very excited about the future.
That's great. No, thank you very much, Andrew. And it's very exciting to see your firm grow over the past decade as well and growing alongside you all. So want to thank you very much for your time. I found it very informative, Andrew. Hopefully we continue success. We continue to grow alongside you all. So for the emerging managers on the line today, hopefully you were able to get a glimpse of one of our success stories for LACERS. Hopefully we could establish an initial dialogue and develop a rapport with you all. So with that, I want to thank everyone for the time, and we'll now pass it off to our general manager, Guglielmo. Thank you.
Thank you.
Hello, I'm Neil Guglielmo, General Manager of LACERS, and I'm going to provide the closing for our 2024 Emerging Manager Symposium. I would like to first start off by thanking President Chow and the entire Board of LACERS Commissioners for their leadership and vision, and to acknowledge the fantastic work of our CIO, Rod June, and the entire investments team. Our investments team make LACERS Emerging Manager program one of the best in the nation. I'd like to briefly recap the program that we have today. First, a beginning of our symposium with opening remarks by our CIO, Rod June, followed by a recognition of our Emerging Manager Program graduates. Next up, we had Ellen Chen, LACERS Director of Private Markets, interview Brian Lee, a principal with Oberweis Asset Management, followed by Wilkin Lee, our Deputy CIO, who interviewed our second and final person, which was Andrew Adams, Managing Partner and Co-founder of Oak HCFT. In addition to our symposiums, here at LACERS, we have considerable investments and emerging manager related information available on our website at www.lacers.org/investments. From there, you can navigate to our investments performance reports, RFP and contracting opportunities, Emerging Manager Symposium, and Emerging Manager Resource Library. You can also contact our investments team at lacers.invest@lacers.org. Finally, I would like to thank all of you for making the time to participate in this symposium and to encourage you to continue to engage with LACERS. We value your input and will incorporate feedback and questions into topics for future symposiums. And I also look forward to seeing you at the next LACERS Emerging Manager Symposium. Thank you.